Good morning, traders and investors. Roger Scott here, senior strategist for The Trading Pub. It's Tuesday. It's October 3rd. It's about 7:56 in the morning. The market's going to gear up to open up in about an hour and 34 minutes. Welcome, 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 and hello there. Now, before we get into it, I'm going to make this very, very quick. Subscribe to our YouTube channel, Roger-Scott YouTube channel. Subscribe to our Telegram channel. If you don't know where to find the link for it, just go to rogerscott.com/Telegram. And join me in my VIP room that's happening at noon today. You don't want to miss out. The link is in the YouTube channel above or below this video. Now let's get started. What are we waiting for? Man, I did that in 38 seconds. I'm getting good at this. I see a new job, a new career in my future. All right, I'm just messing around. This is about it for me. This is about as good as it gets. All right, Nasdaq is down about 81 points. This is slightly beyond random. I'm not happy about this. The Dow's down about 137 points. Yesterday's Fed data, and I'll talk about that, was online. There's nothing really crazy here. There's nothing out of whack. There's nothing out of line with expectations. Today we have job openings report. This is coming out half hour after the opening bell. So we're going to have a pretty muted first half hour. Because this is going to set the tone for at least an hour or two afterwards. I'm assuming if the report is meaningful. If it's not very meaningful, it's not. But this is going to be talking about job openings, and job openings are very, very important right now. And we're looking to see if the number's going up or down. We're looking at about 8.75, and you could see here the consensus is right 8.5, 8.9. So it looks like it's going to be right in the middle. Another major factor that we need to pay attention to right now, and this is important, is the bond market. One of the reasons why we're seeing, you see more downside, one of the biggest reasons we're seeing a downside in utilities is because yield on bonds is getting bigger. You see that? And same thing with consumer staples. When yield gets higher, food costs become more expensive. So it's an automatic deduction for consumer staples. Three major sectors, really. I mean, three major sectors. You got consumer staples, utilities, and also real estate. Real estate, higher interest rates. But real estate, let's see how it's been reacting last few days. Let's just see here. Yeah, it hasn't been doing that well. But that's because of higher yield on the bond market. And this morning, we are going higher as well. It's kind of odd that the Fed expectation of raising rates is only about 30-something% in December. I would think by now it would be pretty consistent. But this is putting more and more pressure on the market. And notice I've never taken counter trades, counter to the bond market. The reason is very, very simple. You want to stay with the trend. You never, ever want to go against the trend and pick bottoms. We haven't done that in a very, very long time, and our win rate has been very solid on the bond market. I got to put on a bond trade. I haven't done one in a while. Looking at major factors today, you've got two companies. Cal-Maine, which is an egg supplier, right? They supply egg, which is a consumer staple. I think it's an egg supplier. I'm pretty sure it is. Let's just double check. I don't want to say anything crazy because I'll get emails for the rest of the day. Yeah, eggs. Okay, all right, eggs. It's a egg producer, which is a sub-consumer staple. And you also have McCormick, MKC coming out here. MKC. Now, I'm not sure if those stocks are coming out before or after the opening bell. Probably before the opening bell. As you can see, the stock is down 3%. And there's possibly more downside here. So these stocks are not looking all that great today. And Cal-Maine isn't looking all that great to begin with. It lost 2% yesterday. It has earnings today. So be very, very cautious. The expectation is 33 cents per share from Cal-Maine. And from McCormick, they're looking at a revenue of 5.8% up and earnings, EPS, negative 5.8% down, 65 cents per share right here. Sorry, that sound you're hearing is my phone. I forgot to turn off the silencer or turn on the silencer. But that's what's on the table today. So you really, really want to keep your eye on consumer staples, which were a hot sell-off yesterday. And we were taking advantage of this and the utilities and a couple of other stocks for our day trades. So keep your eye on consumer staples. Keep your eye on the bond market. Very, very important. And most importantly, the JOLTS survey that's coming out. Now let's talk about what else is on the table, and then I'll get into all the technicals. There's some interesting things that are setting up in the market right now. Market participants looked ahead to a fresh labor market data, JOLTS survey, while hawkish rhetoric from the Fed officials kept Treasury yields elevated. Oh yeah. Again, I don't know what people are expecting. I mean, honestly, I had a big problem with Squirrely Powell beginning of the year because he was just not being honest. But lately, like the last two meetings, they've been pretty transparent. I'm not really seeing anything crazy, but people don't get it. We're in a bad environment. We're not in a hyper bull market, folks. Don't expect the same thing. Meanwhile, yesterday, in light of me just saying that right now, I'm about to make an ass out of myself because the Nasdaq 100 outperformed the benchmark, which doesn't usually happen in that type of market environment, but here we are. Underpinned by a gain in NVDA, I gave you a heads up on that after Goldman Sachs upgraded the stock to a buy. Mega cap technology stocks gain ground. Meta, Google, risk rising more than 2%. I'm going to talk about Google, Costco, and NVIDIA in a few minutes, actually. So, and Kellogg's created a new business called WK Kellogg, renamed itself Kellanova, God bless itself, plunged 6%. People are not happy about that. Target fell. Consumer staples, consumer discretionaries were taking it under the chin. The ISM, the Institute of Supply Management Manufacturing Index, came in at 49, stronger than 47.7. The U.S. September global manufacturing came in at 49.8, stronger than the expectation, and construction spending rose in line with expectations. So yesterday's Fed data wasn't really here nor there. Now, here we get to the good stuff. Bowman said Monday that it would likely be appropriate for rates to be raised further to bring inflation down to the central bank's target even after August, showed that some of the slowest price increases since 2020. I continue to expect that further rate increases will likely be needed to return inflation to 2%. I couldn't agree with her more. Barr stated that central bankers' biggest question was the duration of which interest rates should remain at elevated levels. In addition, Cleveland Mester said central banks will likely need to implement one more rate hike this year. Folks, the good news is we're getting closer to the end, not the beginning. That's the beautiful part. I turned my sound off. That's the beautiful part. We're towards the end, not the beginning, but we still have a while to go. This is a time to be careful and just wait it out, because this could mean a soft landing. Yes. Now, with all of that said, there's still only a 38% probability of a 0.25 basis point hike in December. The numbers have been between 29 and 39, 29 and 39. And this is the November numbers are not changed. They're probably not going to be in November. I would be surprised. But December, I'm expecting this to go up to about 50, 60, maybe even 70%, because interest rates are going higher. So it wouldn't be unlikely to believe that this is going higher. I don't see why, in light of what she's saying right here, I don't see how this number could be at 38.2%. But that's pricing in their sentiment, and this is pricing in based on what the bond market is doing right now. Which means if the bond market is only pricing in a 38% of a chance of a 0.25 basis point rate hike, that means it could potentially fall quite a bit more. Because if it's only expecting that, that's one of the reasons why the bond market fell so much. It wasn't expecting this much more. It was pricing in lowering yield. Remember, Feds were expecting higher rates. The bond market was expecting lower rates, and then it fell out of bed. This could happen again because the expectation right now, listen to what I'm saying. You're not going to hear this nobody talks about this. If the expectation is only 38% according to the bond market, and the Fed is saying there will more likely than not be another rate hike, and they're being consistent about this, that means there could be a lot more to go, and that could put more pressure on consumer staples, utilities, and other sectors that are impacted by rates, like technology stocks. Hello. You got to start putting two and two together. This is way low of a number for what they're expecting right here. Today we're going to get the job openings report at 10 a.m., 30 minutes after market opens, and Bostic is going to talk more and probably say exactly the same thing that Michael Barr and Bowman are saying. We need more rate hikes. Again, this is very low. This is 38%. I would expect, based on what they're saying, that this number would be 65% right now, which means more downside for the bond market. Europe is touching a 6-month low. They're not doing well. Bank and insurance stocks are gaining, while rate-sensitive utility stocks underperformed amid the prospect of higher rates. Does that sound familiar to you? They really are keying off of U.S. Japan, that's in Europe. Japan closed lower today, hitting a 4-month low. We're not getting any tailwind from Europe or Asia. as worries over higher U.S. interest rates for a longer period of time weighted on sentiment. How come we're not seeing it right here? I don't get it. 38.2%. I'm very stuck on that. That's just off. That's just totally off. Energy stocks were a big drag on the market, just like they were here. Crude oil is down 2%. And don't forget, we've got McCormick and Company, consumer staples, and egg producer, which is a commodity / egg producer. Looking at the futures market, let's look at energies real quick. They're not really down all that much today. Let's take a look here. Kind of expecting energies to start bouncing up again. Yeah, I think, let me put on a different template here. Yeah, here's the 50-day moving average. Here's the 20. We could go more down, but I'm telling you, we're pretty overdone right now to the downside. I'm actually thinking we're going to rally. Yesterday, we came off the low, and we rallied a little bit. It's too early to tell. We'll see. But I'd like to see crude oil go higher. And if you look at XLE, it's got all the energies in it. It's right at the 50-day moving average, right at the 50-day moving average. So if we can close today above the 50-day moving average, I would be okay with it. What I don't like about it is the fact that this low is lower than this. Now, let's get to business. QQQ. QQQ bounced off of the resistance far away from the 200-day line, abutting that 100-day. You got to keep your eye on that 100-day. If it can bounce above the 100-day, I will start getting more bullish, but that's a big if. SPY, let's look at the SPY, is in a down channel right near the 200-day moving average. Let's see where the 100-day is. Let's look at the 100-day here. Sorry, taking so long with all this stuff. There we go. So we're way below the 100-day. We're in twilight zone between the 50, not even 50, and the 200, 100 and 200. I'm not liking this, and I'm not liking the fact that we're in a descending channel. I would need to see us break above this channel. Otherwise, the odds are of this is going to go down. Now, if we're staying in the channel, which I think may happen, we're holding it pretty well, we may start coming up. So look for possible break of this channel, which would coincide with the 200-day, or which would not be good, or us coming back up to the channel, but we would need to break above 432 to find out. Looking at the Dow Jones, we are below that channel, and we're below the 200-day moving average, and we're not doing really, really great. Now, there is some support. The fact that we're breaking this and filling this gap is very, very bad for blue chips. And it looks like we're going to go way, way lower. But the fact that we're below the 200-day moving average is negative. I just want to look at semiconductors one more time real quick. Chip stocks are looking pretty good. It looks like they are bouncing off of this level. But again, we're abutting the 100-day, so be careful right now. Now, I want to show you some stocks that I'm really liking right now, okay? I'm liking a lot, like a lot. I'm liking Costco a lot right now. If Costco breaks out, which it looks like it's doing, it can go up for another run-up. I will be, if Costco can break above 572.52, which is only about a point away, we can see a swing high. So this would be a very good day trading, swing trading stock for today, Costco, but it's got to go up above the previous high right here, which is, it's almost there. Really wouldn't be very much to get it up there. The other stock that I really like right now is Google. And you can use GOG or GG, it's the same thing. I like how it's breaking above the 50-day moving average. I like how it's shrugging off this bearish market. I like how it just made a swing high previously, which is something a lot of stocks are not doing. I love how it's filling in this gap, and I love how it's hugging the 50-day moving average. I would want to see it trade above 135.28. If it does, it's in play today. I think the stock is going to go back to 139. Lastly, NVIDIA. I really like NVIDIA. It got upgraded yesterday. It's looking really good. It's kissing the 50-day moving average. I think it's going to break through the 50-day moving average and come all the way up to 484. That's one of the reasons why I'm not selling the call on it. I think it's going to go higher because we have a put on it. So I think NVIDIA, Costco, and Google are set to go higher. If they don't, again, keep your eye on these stocks. I'd like to see NVIDIA trade above 459.54. Now, that's that. Now, let me give you the sector watch. The best sector right now is still the energy sector over a 3-week period. This week, believe it or not, it's retail in QQQ, and energies are all the way down here. But I would go with the last 3 weeks. I would go with retail and energy. Retail, energy, communication. That's where the money is right now. Communication is Google, by the way. Google. And retail, Costco. And communication is also Google. Yeah, Google, and retail is Costco. So we got energy, retail, communication. The weakest sectors right now is utilities. Let me try to do this by, utilities, real estate, doesn't change. Utilities, real estate, and home builders. Real estate, utilities, and home builders are not having a good time. Energy, retail, and communication services are still the best sector. Now, before I let you guys go, folks, I've stumbled upon a fascinating quirk in the options market. Once it's delivering double and sometimes triple-digit returns from a mere 1% move in the stock market. Imagine, if you will, a $10,000 theoretical pot and its potential growth over a decade. Leveraging this anomaly, it's bound to leave you astounded. Are you ready? Are you ready for the lowdown? I hope so. Tap the link below for a deep dive into this technique and get ready for the next alert. Don't miss out. Follow the link below. You're going to love this. I'll see you guys later. Have a great day. Email roger@rogerscott.com. Post below the video. Check out Telegram channel, VIP room at noon. Post comments below this video. Bye, guys.